Oh, hello. We're live. So, good morning and welcome everyone to episode 15 of Mortgage News Live, coming to you from wet and rainy Hertfordshire. Thank you as always to our sponsors, MPowered, and of course the legends at Newspage. We have another exciting show this morning where we'll be talking even all things mortgage market-ish wise, and also taking a further look at low deposit mortgages and first-time buyers. In the news this week, despite the recent Bank of England base rate vote, where another member of the MPC called for a rate cut, yay! Swap rates, however, do not seem to have. They were up a touch slightly today, but the good news is that there is at least more stability now. Lenders have been putting rates up a touch, though, with NatWest increasing slightly today, following Santander yesterday. However, there is some good news because MPowered mortgages, big cheer, have reduced 2 and 5 year ranges on both purchase and remo. So they do have some good offerings there. House prices themselves are down a touch, but seemingly starting to recover once more. Again, albeit in a fragile manner, according to eServe. And one of the big talking points in the industry is around some lenders' take on consumer duty and why we are seeing some starting to dictate what a broker's fee should be in certain product ranges, something I wholeheartedly disagree with. Also, according to consultancy LCP, more than 1 million people took out home loans that will run into their pensions over the last 3 years, forcing young people to gamble with their retirements. Their words, not mine. Meanwhile, it's worth a big hello to those brave souls, the members of the Mortgage Industry Mental Health Charter, who are currently embarking on a symbolic journey from Crystal Specialist Finance offices in Tamworth to the HSBC office in Canary Wharf. That's a long way. Over the course of 5 days, Jason Berry, Jonathan White, William Lloyd Hayward, Jane Benjamin, amongst others, are walking to raise awareness about the importance of physical movement for mental well-being. But enough of my rascally rantings and over to this week's expert panel, who will be discussing all this and whatever else we meander into. Joining us are Rita Coley from the Mortgage Stop. Hello, Rita.
Hello.
Robin Falk from Hawk FS. Hello, Robin.
Hi, guys.
And a return for Ben Perks from Orchard Financial Advisors. Hello, Ben.
Hello.
Hello. So, welcome back all. And where should we start? Well, first of all, let's start with swap rates then, because I like swap rates. They're not budging really. So the question is around first-time buyers. Are you guys seeing first-time buyers still waiting to see what happens with rates? Or is actually there now a sense that, look, everyone should just get on with it and find that home before recovery does come and pushes up prices? What are you seeing your end? Let's start with Rita.
I've had a lot of inquiries just to understand affordability and what is the maximum they could potentially buy up to. But there's not necessarily the noise. They're not too worried about what swap rates and base rates doing, but more so what's practical for them. Yeah. And we keep touching base, but it's taking much, much longer for them to get to the house that they want to buy. I'm finding they're a little bit more pickier as well. They don't want a flat, they want a house. They're willing to wait a bit longer to get that ideal house, starter home. But also it's just too expensive for them. So they're prepared to wait for that ideal opportunity. So I've been speaking to nearly 18 months ago. We just keep checking in with each other, say, has anything changed? Anything out there?
Yeah.
Definitely there's more activity in the market than there was last quarter. But still not within their range. So that's not impacting the noise isn't impacting them. It's what's really ideal for them.
Oh, what about you, Robin?
I think you'd say what's the driver? I think you're seeing people, if they're still living at home, there's no real motivation to move apart from wanting to, either shack up with a girlfriend or a pal or whatever.
Yeah.
I think if you're renting, I think it always makes sense. You know, you're putting your money somewhere else. I think we're seeing that renters, first-time buyers are happy to proceed, and maybe people are holding out the Daily Mail and BBC saying that we're going to see some rate cuts one day. Those first-time buyers that possibly, you know, still at home, they're in no rush. I think the challenge we're finding is not what the borrowing that people can achieve on their incomes. It's actually the cost now, what the monthly costs are. And you mentioned about lending into retirement, you know, stretching a 29-year-old on a 40-year term, things like that. And that's now buying first home to get it to be a monthly affordable cost. That's a real, that's the challenge. And who's predicting the future that they're going to double their salary in a certain period of time, be able to overpay? I don't know. But that's what we're seeing, or what I'm seeing at my end.
Yeah. Okay. Ben, what about round your way?
Yeah, similar really. I think the first-time buyers have been definitely the first ones to sort of poke their head out, and that they're not sort of deterred hugely by the noise in the media. And the other thing that's interesting is, as well as all of the noise in terms of interest rates and the cost of mortgages, there's also a load of noise on the cost of rent. So they're not just thinking, oh, well, I'll go and rent for 12 months. So they are now considering, instead of moving out and going into rented, they're thinking, right, we'll stay as we are. We'll stay at mum and dad's and bide our time. So yeah, it's definitely a slower, more cautious process, but they're certainly not deterred, because fortunately for them, they haven't got the sort of the harangue of the good old, sub 1% mortgages even. So they're not deterred by the rate and the noise. It's just they're a bit more cautious.
Yeah. So is it then that it's actually the average deposit that's the main issue for people, or is it affordability generally speaking? What's the biggest issue that you're seeing, Robin?
I think it's both. Some people are fortunate, and we talk about people. I'm just looking at a client at the moment. They're getting a £350,000 gift. Their affordability is a completely different world. It's
that's part of the problem, isn't it? Is it? Are we getting more and more into it's 100%. The haves versus the have-nots?
I'd say so. I mean, we're based southeast, and that the size of deposit is a massive driver versus the size of the loan that you need to take out. A 95% loan on a 300 grand flat is a considerable amount of, 285k. You need some income to purchase that. And it can be a challenge, but we are seeing a lot more, and I'm sure we all are, a lot more handouts from family, from friends and family, to just bridge the gap between what is affordable, given where the rates are and what people can actually borrow. Looking at 4.5 times for first-time buyers. You don't want to push it to 5, but it's probably where we need to be. With more lenders lending 5 times income for first-time buyers, especially in the southern half of the country. It is regionalised, unfortunately, this country, and it does make a difference on what the cost of property starts at.
Yeah, is that the same for you, Rita? Go on.
Yeah, I'm finding sort of similar to Robin, but also definitely work hand in hand, size of deposit, affordability. I'm also getting people working second jobs now, out or going self-employed and doing it, and then you're having to say, well, we can't accept it. We need 2 years accounts, or whatever it is they're doing just to boost up that extra income. I'm finding that I'm having to squeeze if they're on a low wage and they've got benefits. We're trying to scrape every penny of their benefits to boost up affordability. But then there's challenges there that if they've got certain age children, we can't use them for certain lenders. And so there's a lot more research involved now, where before you could sort of go, yeah, these are my go-to lenders. I know that they'll you should be okay with affordability. You're kind of almost having to triple check everything now and rerun affordability calculators, and they change like every 4 weeks, and you're going, oh, hang on a minute, that just because it's impacted by the rate changes. So I feel like we're doing a lot more administrative work to get the same results as we would have done maybe a couple of years ago or so.
Ben, you working harder than ever? You look quite chilled out and relaxed.
Well, I'll try to. No, definitely. There's a lot more research and a lot more experimenting with affordability calculators, because, like you say, they are changing all the while. You know, you can do an affordability calculator 1 week, and then the client will come back and things have been tweaked ever so slightly. So that's definitely a factor. I think locally in the Black Country, I think it's probably slightly more deposit than it is affordability, because I think we do see quite a willingness, especially for your first-time buyers, that as soon as you say, well, this is how much you can afford, then there's a real sort of blend of properties in the Black Country, you know, so they can say, oh, well, actually, we won't shoot for that property, we'll go for this one then.
Yeah.
And then it becomes all about the deposit to get it. So I think there is a willingness to sort of get what you can rather than what you really, really want. So I'd say probably leaning towards more the deposit issue than affordability.
Yeah. And are you starting to see that? Because actually, I know it's a different, just in this London market. There's a client yesterday I've been talking to for ages, actually, and he found a property over the weekend, went in, saw it. I actually spoke to him on the Sunday, and by Monday morning, even though it had just been on the market for 48 hours, they'd had 3 asking price offers already, and they're all considering going over asking price. Is that something you're seeing as well? So that's sort of the warning to first time buyers, and that's something that I guess a lot of them are concerned about. If they can't get the mortgages now, they're going to miss the boat again, aren't they? Because house prices have dipped now, and once all that pent up demand comes back into the market, especially in high demand areas, prices are going to rise again.
I saw exactly the same yesterday as well, Monty.
Did you?
Yeah, 4 or 5 people offering over asking for a property.
Really?
I think it's down to quality of stock as well, like you say. The good,
exactly. Yeah, absolutely.
The good properties people are fighting for, and and maybe the not so appealing are sitting there for a longer time.
Yeah.
But we also, I think we see this from the estate agents that we deal with, and some people have still got aspirations to sell their house for post-COVID money rather than the market we're in now. So that does drive down valuations. Where which I don't know. Has anyone seen many of those?
We've seen a few. I mean, I'm quite interested in how your clients are reacting to down valuations. Are they then going back and trying to negotiate or even pull out, or are they still willing to pay the prices that they offered anyway?
That's definitely renegotiating, is what we see with the down val now. It was a case, like you say, sort of a couple of years ago, they were being down valued, and people were like, well, it's okay, I'll still pay that amount because they're so desperate to try that property. That's not happening so much now. So, you know, it's more important than ever now that the property gets valued up from the vendor's point of view.
Yeah. So in terms of, I want to pick up actually a point you were talking about, Robin, in terms of the longer term mortgages. So I said at the start that we're seeing more and more lending into retirement, etc. We know why some people are doing it, certainly first time buyers, in terms of trying to spread the payments so they start off paying less. Are you seeing a lot of this? Are you concerned about it? And could the new breed of sort of the long-term fixes that are coming in from people like Perenna and April, could they be a useful tool for first-time buyers, or anyone really trying to get a lower deposit over a longer time period?
I think it's damage limitation, isn't it, with the longer terms? In terms of the longer fixed terms, I don't think the rates are attractive enough yet to get people to dive into a 10+ year fixed rate. I think people have still got the optimism that things are going to get a hell of a lot better. a couple of years ago, people are kicking themselves now for not fixing for 10 years at 2 point whatever.
Yeah, I know. Yeah, tell me about
it. So I think it's the longer term fixed rates. There will be people that they suit, definitely, and I'm all for any sort of innovation in terms of products, but I don't think that I don't see the take up just yet with the interest rates where they're at.
I think there's
Rita,
innovation needed in the longer term fixed rates, Monty. I think there's innovation.
Sorry, Robin.
There's innovation that's needed in the longer term fixed rates that people can. They're flexible for people in different changes in lifestyle.
We're starting to see that now from April and Perenna in terms of the way that they do it. So it'll be interesting to see whether these start to take on in terms of lifestyle changes, in terms of I think it's April that as your rate reduces, potentially as your loan to value reduces, you can move on to a lower rate. Penalties only within 5 years, that kind of thing. So I think we're getting there on that.
Yeah, I found there has been an uptake. We've had quite a few inquiries coming from sort of the likes of Perenna, just people liking the idea of not having the hassle to remortgage and worry about what their income's going to be and going through all the affordability checks. And especially if we are going to be doing longer and longer term fixed rates, the question then comes down to, are you paying into a pension? And when you're a first-time buyer, it's the least of your worries. Are you paying into a pension? But you then have to explain why you're asking those questions. And I feel that it's now going to be the kind of, in a few years' time, going to become the next big consumer duty around why are we taking terms beyond age 70, 75, 80? Is it justifiable? Because at the moment we have to justify it from where we are today, and can they still afford their mortgage in their 80s? Are they realistically going to have a mortgage? Well, they probably will in their 80s, but what are the other options? And I think there's going to be more of a concept of advisors like us having more holistic approach on, well, actually, okay, we're doing you a 40-year mortgage, you'd be 75. Have you actually thought about what is retirement going to look like? It's almost, I feel like there's going to be that gap between financial services and mortgages because of how lengthy those times are. And also going back to affordability, I'm having a lot more meetings with parents. So it's not just bank of mum and dad, it's actually how can mum and dad support child to get onto the joint borrower type mortgages or the generation home type proposition. So it's just finding unique different ways of getting people on the property ladder.
Yeah, absolutely. And that innovation is key, isn't it? And I'm trying to look around and see who's the oldest there. I'm gonna plump with Robin.
I had a very uphill paper round. Okay,
you're not as old as me, mate, so it's all right. No, I just remember in the old days you had proper guarantor mortgages, which actually a parent could. It wasn't like a joint mortgage, but if one of their kids were short, then the parent could guarantee just say 20% of the mortgage or 30% of the mortgage rather than being liable for the whole lot. But that seems to have gone ages ago. Where are your thoughts on things like that and innovation generally where you can help people get onto the ladder?
This is the kicker, Monty. We've just been talking about having to stretch mortgage terms out for first-time buyers to afford it.
Yeah.
But then you're having to reduce mortgage terms because lenders are sticking, they're going to the maximum age for the guarantor. And it just doesn't, those two, that's a square peg in a round hole. It just doesn't fit. And I think that's that generation H, Rita, you mentioned there, that generation, I think they call it a ejector seat mortgage or something, but you can, the affordability when the parent's age hits, that's what your client, the child or the younger person, that's where it's deemed it should be for. I mean, that's a great movement and innovation. I think almost most of these donors or these guarantors have a property of their own anyway. Having a dual charge, if lenders are worried about their security, and the fact that these people aren't going to pay the mortgage, even though they're renting for £2,000 and their mortgage is 1,800 quid with a guarantor on top. If they think that having a dual charge, is that another solution? I don't know.
Yeah, well, we used to see that was part of it as well. Do you get a sense, Ben, that innovation is stifled at the moment, and why do you think that is?
Yeah, I think it's because the emphasis around affordability, isn't it? You know, if they're putting with the joint borrower sole proprietor stuff, if they're putting somebody on an application, they've got to make sure they can afford it, and they can't take the parent into retirement, so their hands are a bit tied with that regard. But that is the biggest stumbling block in terms of joint borrower sole proprietor, because if you're a young person looking to buy and you just need a little bit of help in terms of boosting income and what have you, you can't put your 60-year-old dad on there, because all of a sudden the term's getting cut in half or close to. So that's the biggest stumbling block. But they're just a bit, I think their hands are being tied by the regulator. I don't know how they're going to get around that.
And also,
but they need to.
I think I remember back in the day, I used to work for HSBC and the early days of starting Mortgage Advisor, and they used to do this product where it would be kind of like a home start. First 3 years as a first-time buyer would be on interest only, and then in
Low
year
start
4,
mortgage,
yeah. And I think something like that again should be brought back, because it's getting people back on but also it's not getting them into the trap of staying on interest only, because obviously we know the interest only is much tougher to get anyway, but it's just giving that little bit of an edge where they don't have to involve any family members. So just something like that would be good to bring back.
More products around the charge as well. Sorry, the charge on a parent's property. There's not, there's many parents out there that would love to help their children, but they haven't got £30,000 spare in the bank that they can even with Barclays, in the Springboard mortgage, they can't afford to whack that into an account and lose it for 5 years. But they're sat on a mortgage-free property, which has grown in value greatly over the period that they've lived there. So there's just more innovation around that potentially. There are products out there, but there could be a hell of a lot more.
Yeah, I agree with that. I think it is interesting, isn't it? Because the lessons, a lot of the solutions are in the past, and it's about picking the things from the past that actually worked and ignoring the things from the past that actually caused issues, isn't it? So
is it the regulator that's stifling it though? Put your Amy hat on, Monty, but is it the regulator that's stifling it, or is it the lenders? Because they just want it simple. They just want a bit of vanilla. No,
I think honestly, if you speak to lenders, they would love to do a bit more, but there is complications in terms of regulatory pressures, in terms of capital adequacy rules, in terms of a certain percentage of above 4.5 times income. All of those type of things conspire. And then you've also got things like, I know it sounds ridiculous to still be talking about this like 10 years or so after we started talking about this, but it's systems issues. So a lot of lenders, for example, struggle to do things like offsets because of not just capital adequacy, but also because systems issues and stuff like that. So yes, we do have a new breed of lenders coming to the fray. You've got Generation Home, obviously you got MPowered, potentially a few others who are coming to the fray, but we really need some fresh thinking and some help from the regulators to try and get some more innovation out there that can be effective, and also it can be profitable to the lender, obviously good for the clients, but actually safe as well from a regulatory perspective. But it is tricky. There is a balancing act there. Just anyone watching, if you do have comments or questions, please do put them in the chat. Rita, someone called Rohit has said to ask you lots of hard questions. So
Why am I not
apparently
surprised?
related to you.
Not surprised.
So, but he hasn't asked any hard questions yet. So what in terms of the sort of the low deposits, then we've had Accord come out with their 1% deposit mortgage. We've had Skipton with their track record at 100%. Rita, are you seeing a demand for these types of products? And are they potentially more of those? Are potentially they a bit of an answer to this?
In the short answer, no. I've had one inquiry for the
Right, okay.
Skipton proposition. It's just because I think people are wise to it that there is a higher interest rate involved. Affordability, again, it goes back to the same conversation we've just had. It's really, really tough to get the affordability for the price range that they're looking for. It's not practical.
That's a nice short answer. There you go.
But they're nice. They're nice to have out there. I mean,
they're a start, aren't they?
Sorry?
They're a start, aren't they?
They're a start, but I think there's a sense to these small deposit mortgages. If you've got, and again, it might be regionalised, and I don't think any of us go far enough up the country here, but it might be regionalised. But if you've got a small deposit, again, go back to the £300,000 property, and you're going to put 5% in, you've got to borrow 285. In theory, what we're looking at for there, you need 70 grand income joint, 60, 70 grand income. If you're not saving any money for a deposit on a 60, 70 grand income, you've either got some really bad habits or I don't know what you're doing with your money. And that's where I don't think, it's very few and far between that these are going to meet. I'm just reading this note here because Malcolm Davidson.
Yeah, Malcolm.
He's going to have a wind up, isn't he? So,
Ossie said the top 10 lenders should be banned on using the word innovation. I agree with Monty. The innovation is the domain of the smaller lenders. Look at Skipton track record. But a rehash of something 30 years old. Yeah, it's interesting. Ken, thinking about the source of deposit, do we feel that the time is coming where lenders will start to have to accept crypto as a source of funds, given the amount of money, the amount of people who have this type of investment these days? That's an interesting one, Ken. Any of you into crypto?
No, I'm not.
No?
You've already called me old. Come on.
We haven't got time to be looking into crypto.
Some lenders, a couple of lenders that will accept it as a deposit, I think. I can't remember who. But,
I can't remember, to be honest.
Yeah.
I'd have to search that up. I think if crypto becomes more stable and more accepted, then I think potentially they will. If it's been cashed in and it's cash, why would you not accept it?
Well, it's no different to using your gambling winnings, then, is it? If it's been cashed in.
Yeah, it's still money you've made.
Yeah.
It doesn't mean you're gonna reinvest loads of money again and then lose it all, because it's then in the property. So anyway, I'm a bit confused about that crypto as a source of funds, because, as I say, if I've got 100 grand in crypto and I cash it all in, that's 100 grand of cash. So why shouldn't that be accepted? Don't know. Food for thought there. So the other thing actually I wanted to cover was around low deposit mortgages. Are they available for some of the most important people? So self-employed, company directors, contractors. So the real heartbeat of the British economy is loads of small businesses. Do you feel that they're discriminated against more than the people who actually work for them? Because you can work for, it's always amazed me that actually it's easier for maybe my employees to get a mortgage than me, because I'm technically self-employed. So is that somewhere that that lenders should be looking at?
I think definitely all through that COVID, I was amazed that the self-employed were second-class citizens, should we say, on the in exactly what you just said there, Monty, on the basis that the employees that are working for a firm, they can get a mortgage, but they're under redundancy notice, and and they've not declared it, whereas the actual person fighting to save the business has got no hope. But what do they do? How that's in my opinion, that's just lenders being extremely protective of themselves and de-risking everything at a point which is almost a nonsense for us trying to find mortgages for people. But going to a comment earlier about the smaller innovations from building sites, thankfully they still hung out there, so there were still options for us poor self-employed people. What would we do without them?
What about go on, Ben?
Oh, sorry, I was going to say, I think that a big thing is the time. So, when you look at self-employed versus employed, you can day one, you can get a mortgage before you've even started the job with some lenders if you've got the contract. Yet with that same lender, you've got to have 2 years history of being self-employed. So it is it's that time really in terms of the waiting. So it'd be great to see some innovation around projections, around sort of what they've done prior to going self-employed. If somebody's started self-employed and they've been employed for several years in the same line of work and industry, it's highly likely that they've got a load of contacts and they're going to hit the ground running relatively. So it would be a lot more beneficial if we had projections coming into play with more lenders. It's then whether or not the accountants are willing to provide them, which most are, I think, if you've got a good accountant.
Yeah, I think most are. Rob's answered the question. There you go. Generation H, Pepper Money, Barclays and NatWest accept deposit with crypto gains. There you go. We have a very learned audience. In terms of government and regulators, in order to help first-time buyers jumpstart onto the market, obviously we saw Help to Buy. We've now got Own You. There seems to be still a dearth of shared ownership, or is the term shared ownership? Do people basically think less of shared ownership? I know, so there's some really successful companies, broker companies, who just do shared ownership. That's all they do. Is that something we should be we should be doing more of? And what actually do you want to see? Obviously, we're going into an election period. Housing is going to be a big part of it. What do you want to see from government to really help drive first-time buyers and the property market generally?
I think we need a scheme. I mean, Help to Buy did help people to buy. Did exactly what it said on the tin. Shared ownership's picking up. So we do a little bit here of shared ownership of a team of people dealing with shared ownership. But the issues still come down to affordability, because the share is, the rent they pay drives their service charge, ground rent and share, and you're finding that's being squeezed. Always say cost of living, but that's being squeezed. So it's finding a scheme that works and is affordable. But I don't know. Everyone wants a piece of the pie. The developers want their piece of the pie. Everyone wants something. I don't have the solutions, but I heard that Rita does.
Sorry,
mate,
Rita, apparently you have.
I just got to get my golden book.
That was an under the bus.
You got a golden book.
Yeah.
What do you think, Rita?
No, I think shared ownership, whenever I mention it, a lot of people shy away from it. They don't like the idea for some reason. They don't like the whole, I want to own my own property, even if I have to wait another year or so to save up for that deposit or get mum and dad involved or whatever. But shared ownership doesn't seem to be quite popular where I am. It's not something that they're very keen on, but we'll look at those options. I remember sort of the key worker scheme, but that came in. It was before the sort of the Help to Buy. That was quite popular as well. Just kind of people motivated that worked in the NHS. It was really slightly teachers. And I think it boosted up morale as well for people who were in those sectors to be able to have that privilege to buy these new builds that were coming on board. I just think something like that, again, to get a little bit of buzz again in the atmosphere, as well as getting on the property market. What that looks like is I don't know. I don't know if there's enough sort of new builds being able to be developed either. There seems to be a lot of objections where I am. There's a lot of land, but a lot of objections as to where they can build. And I know it's a lot to do with the environment as well. So it's a catch-22 again as to where people do want to build, they can't, and therefore there's still a shortage of housing. So there's a lot that needs to happen. And I think it's got to start with the first-time buyers again. So it all goes back to lenders. What are they going to do to get a boost of affordability in order for them to start moving the market?
I think that talk about there's no decision makers either. I don't know how many housing ministers have we had recently, and when I say recently, we're talking months, not years, aren't we? So there's getting some stability from government and the regulator.
Yeah,
actually having someone make a decision.
Ben, you're in charge tomorrow. What do you do?
Help to Buy, I think, could come back. I think that's that was a good scheme, and like you say, definitely helped people to buy. Shared ownership needs a bit of tweaking because the last few that we've tried have failed on affordability, because the people that are looking at that often, if you've got a single mom looking at a shared ownership, which was my last case, as soon as we added in the rent and all the other bits and pieces, it just fell out. It'd be great to see the government leaning on the Bank of England a little bit, sort of put a bit of pressure on. I know they can't make the decisions for them, but we don't have to sort of blow their trumpet every single time. We could put a bit of pressure on and say, come on, why are you so fixated on this 2% target when 2.5 would be fine? Let's get the bloody base rate down. It'd be great to see.
I'm sure they will be doing a little bit of that in the background to try and get some good
do it publicly. Sort of those things. And the key thing is just schemes that don't exist yet, that try and identify problems and come up with solutions rather than just, at the moment, which is treading water a little bit.
Yeah, it's all that short-termism, isn't it? It's difficult. I've long said that actually you need a housing czar, basically, a long-term plan that's cross-party, and you're right, Robin, a housing minister that's actually at the top table. That's all they're responsible for, and they're in situ for at least the whole of the parliament. Someone preferably with industry experience would be very helpful. But anyway, we're not going to solve it now, but there's some good food for thought there in all of that. I just want to touch on, before we go, the discussion I talked about in terms of consumer duty and lenders looking at setting broker fees. Now, I do understand that that's their interpretation of it. My views are pretty well known, but I just wanted to get a sense of, is this something you've seen? Have you seen lenders start to do that with some of your cases, or have you heard of examples? And what do you think about it generally? Ben, there's a hospital pass for you.
Yeah, no problem. I can see why they're interpreting it that way, because there are we've heard of some absolutely outlandish fees out there. Bank of Ireland, whereas something in one of the BDMs said that they'd seen one it was pushing 10 grand or something. It was a very, very large fee. So there are some terrible ones out there. So I can see why they need to monitor it. But the vast majority of brokers, certainly locally, are way below the limits that it was Halifax put in place recently, for example. And when they broadcast a limit, I think that they could end up having the reverse, the opposite impact of what they wanted. Where, for me, for example, I sat here and thought, crikey, we're charging way below.
I thought that as well. Yeah,
and I think you could get people that start to creep their fees up a little bit because they realise how out of sync they are with perhaps competition. So it's a dangerous game, really, because they've set a limit which some people could see as a target.
I just think they're not imposed to do it. It's not their job. My personal opinion. We don't charge fees, Ben, right? We don't. We do when the work requires it, but in general, we don't. I still don't think it's the right for a lender to put that out there, So, it doesn't affect me in any way. But who monitors the margins that a lender puts out? Who monitors that? They monitor it. And I like Malcolm's just put a lovely little note there up as well. And Halifax are good at this amongst a few other of the large lenders. But I'm a DA firm. I don't know what you guys are, ARs or not. But, I get paid less for doing a case because apparently ARs are better quality. Now, Halifax makes that decision, but they've got nowhere that they can actually prove that's the case. I mean, I'm of a mind that the lenders should let us run our businesses because they run their own themselves. Why are they putting their nose in our position? That's the regulator to come and tell us we're charging too big a fee and not offering a customer fair value under consumer duty, surely.
And I agree with Robin. I just think where has that come from? And Abed, you were saying about the sort of the fees. Well, actually, where we are way under that as well. But for me, it's like, what research have they done? Who are they comparing us to? Are they comparing a broker in London to Newcastle? Like, where's that come from? And they should be justifying. Is it just to protect themselves because consumer duties come in? So it's almost come out of nowhere. And is there something more to come in the background? Is that why they're preparing for something else? Is it something to do with proc fees? So
no, I don't think it's to do with proc fees. There are a lot. I agree with parts of all of that. And my view is that it's a regulator's job to do this. And I don't think when the regulator set this out that they thought actually that lenders would cap brokers' fees for certain things. I mean, there are some outliers, and some of the examples I've seen are they're outrageous and they should be picked up. But that can still be picked up in the normal business. If you're charging, $5-6 grand for a 50 grand loan, then you're going to expect a knock on the door. But to go this far is a step too far for me personally. And why is it the broker fee that has to change? What about the lender fee? Why isn't that being looked at? Why is it always the brokers who have to reduce their fees, especially if they can justify it? If they got a fair value statement and they can justify it and it's within their policy, then that's up to them to have that battle with the regulator. So it's an interesting question.
Yeah, but what annoys me about the whole thing, this is where then the wider industry, the clients that we meet, feel that they can justify that we can reduce or they can negotiate our fees for the work that we do, but they wouldn't do that to their accountant or their solicitor. So why is it always down to the mortgage advisors to negotiate what they charge and don't charge when they've got a set fee? That's the bit where the industry then suddenly thinks, I can negotiate with you because I can, and I know you can because you get paid from the lender. Whereas why aren't they challenging all the other services that they're paying for at the same time?
Fair one. It's a fair one. I mean, your accountant doesn't get paid, gets paid by the client, but then the customer, they can compare what they're buying, surely. But if they're paying for the accountant, if they're paying PwC over John Smith down the road, there's a choice, I suppose, same as there is in the mortgage industry. It's
like you say, Monty. It's interesting. The timing of it.
Yeah, well, it's the same with a hairdresser, isn't it?
Yeah. I'll say that the timing of it's interesting because they've started to do this and announce these sorts of things when the lender fees have never been higher than they currently are in a lot of cases, especially if you look at buy to let. So there's no regulation on that. They can, in order to get make the fee look more attractive, they can load the fee. So it is interesting timing.
It's also interesting, Ben, if you look at PTs. I can't knock Halifax on this, but you could knock other lenders if they went down the same route. But why do they pay different for the same amount of work that we're putting in at the other end? And I can't knock Halifax for this side of it because they are good.
No, absolutely. I think it's, we do have to all bear in mind that the people at all these lenders, they're on our side. Yeah, the people we work with, their success is our success, and we are trying to work together. It's how some of these rules have been interpreted and then passed down, and it's about having hopefully we can have a proper dialogue around this with lenders, and we can come to a good solution that suits everyone and regulators. But we can go on about this forever, but we haven't got time. So any last words of wisdom from any of you about the market? Go on, Rita.
Thinking of like innovation, the word innovation, I think what could be an idea, whether and how this would work with the regulators, is if going back to banker mum and dad and helping the first time buyers is some sort of offset scheme where the parent has a nice pension pot. They don't want to draw down from it yet, or savings or whatever, not necessarily the property, but that could be used as collateral to offset to what the first time buyer wants to borrow. And just something like that from government, from the regulators, where families still trying to help, but they're not having to commit physically with their earnings and actually having to contribute to the mortgage, but the son or the daughter then has that step up to getting on the property ladder, would be quite a good way to sort of see the overall holistic financial aspects of everybody, really, and getting that kind of knowledge gap between, well, what does that look like for the parent if they then use that as collateral for the child. Just food for thought.
Interesting. Robin, any last words of wisdom from you?
Just up the palace, really, but no, other than that.
Up the palace. Who's your last game of the season?
We've got Villa, I think, haven't we? So,
Villa. Ooh, yeah, good game.
So yeah, if we can finish above Brighton, it'll be a real good one. But I don't think it's going to happen.
You never know. You never know. You've hit form at the right time.
No,
Ben, anything from you?
No, nothing to add.
Football related or mortgage related?
No, I'll keep quiet on the football front. Wolverhampton Wanderers. So
best you do. And on that bombshell, we are out of time. So a big thank you to our guests, Rita, Robin, and Ben. As you know, we started shouting out a Star Broker of the Week at the end of each webinar. So please tag MPowered on socials when you've seen a broker go above and beyond. Shout out Star Broker of the Week this week is Mortgage Medics Jonathan Smith. Jonathan recently showcased outstanding dedication by assisting his clients in navigating the complex mortgage market, successfully securing a rate that will save them hundreds of pounds each month. So big well done to Jonathan. This is bi-weekly now, so nothing next week, but we shall be back the week after with another packed show. If you have any questions in the meantime, please do let us know. If you want to cover any topics or subjects, let us know. If you want to appear on this, let us know. You can listen to all of these on Spotify. If you have enjoyed this, I've been Andrew Montlake. If you haven't enjoyed it, I've been Natalie Elphick. Until next time, have a great week.
Thank you. Bye.